We are currently watching a massive economic collision. On one side, rapid technological expansion. On the other, a dense, immovable wall of stagnant monetary policy. The 2026 economy is heavily fragmented. If you look at these server racks, you see the physical capital expenditure of the AI infrastructure boom. This sector is driving almost all of our current equity growth. But we hit a policy wall at the central bank. Sticky core inflation at 3.2% has forced Jerome Powell into a prolonged hold, keeping interest rates anchored in a restrictive 3% to 3.25% range. This tension effectively ended the era where bonds reliably go up every time stocks go down. With the 10-year Treasury yield stuck near 4%, bonds no longer have the price appreciation room needed to offset a major equity slide. If both of these assets fall together, as they did in 2022, the mathematical safety net of the 60/40 vanishes. Today, we are testing three heavyweights of quantitative asset allocation: the classic 60/40, Ray Dalio's all-weather, and the golden butterfly. Choosing between them comes down to a specific trade-off: prioritizing peak total return or maximizing your drawdown protection. We saw the illusion of traditional diversification break during the 2022 market crash, when both stocks and bonds fell simultaneously. But a hyper-safe, cash-heavy portfolio introduced its own threat. Playing it too safe leads to a slow loss of purchasing power against 2026's sticky inflation. Successful investing in 2026 requires choosing exactly which specific mathematical risk you are prepared to tolerate. The classic 60/40 benchmark allocates 60% of capital to equities and 40% to bonds. This 60% slice swells, capturing the AI boom's upside. But because equities are wilder, 90% of the portfolio's actual daily volatility risk comes purely from the stock market. History shows the consequence of that risk concentration. During extreme market crises, this supposedly balanced portfolio has suffered maximum drawdowns of nearly 35%. The 60/40 now functions as a concentrated tech growth engine, leaving the investor with a very thin safety net for when the AI cycle turns. That risk concentration is what Ray Dalio's all-weather portfolio was built to avoid. It was designed to survive deflationary crashes. This bar chart maps out the all-weather allocation, highlighting its core defensive input, a towering 40% in long-term government bonds. But in 2026's high-rate inflationary reality, that reliance drags returns to a modest 4.6 to 7.5% annually, lagging the 60/40. Many retail investors try to access this strategy through one-click institutional ETFs, like ALW, which package risk parity concepts into a single ticker. But these funds come with trade-offs. The first is an 0.85% expense ratio that eats into those already sluggish total returns. The second trade-off is more severe. To achieve risk parity, these ETFs rely on complex swaps and futures leverage. That constant internal trading generates high capital gains tax distributions. Holding a risk parity ETF in a standard taxable account often destroys your after-tax yield. The safety effectively disappears once the IRS takes its cut. This brings us to the golden butterfly. It's a contender designed specifically to fix the vulnerabilities of both the 60/40 and the all-weather portfolios. The structural swap is simple. It eliminates long bonds entirely, replacing them with a 20% allocation to short-term treasuries and a 20% allocation to gold. These physical assets, like these stacked gold bars, perfectly counter 2026's geopolitical uncertainty. Pair that with short bonds generating cash yields above 3%, and you have a reliable shield against inflation. On the growth side, the portfolio makes another divergence. It tilts 20% of its equity specifically into small-cap value stocks. That small-cap tilt captures a higher risk premium and diversifies your growth away from the top-heavy AI megacaps dominating the S&P 500. The trade-off is real. You give up roughly 0.7% in annual returns compared to the 60/40, accepting growth lag during major tech rallies. The golden butterfly sacrifices peak bull market gains in exchange for genuine sleep-at-night drawdown protection in an inflationary era. This quadrant chart maps our three strategies. The correct choice depends entirely on your personal panic threshold. First, we have the accumulator. This is an investor 10 or more years away from retirement, who can stomach severe volatility without panic selling. For the accumulator, the classic 60/40 remains the recommendation. The AI growth premium is mathematically worth enduring a potential 30% drop along the way. Next is the preserver. This investor is nearing retirement and must cap their potential losses at 20 to 25% to protect their livelihood. The preserver should use the golden butterfly. Its gold and short bond allocations act as a counterweight to inflation, absorbing shocks of a volatile market. Finally, we have the hands-off risk-averse profile. This is an investor who wants complex all-weather risk parity without doing any manual rebalancing math. We recommend ETFs like ALW or RPAR for this group, but only if they are held inside a tax-advantaged retirement account. Outside those accounts, the internal costs and tax distributions are too high. Outperforming the market on paper is irrelevant if your portfolio's volatility forces you to sell at the bottom of a crash. Hedge fund marketing shouldn't dictate your personal financial strategy. Keep your total fees under 0.20% wherever possible. It is one of the few guaranteed returns in investing. In the complex economy of 2026, success relies on picking the one asset allocation that lets you sleep at night and letting decades of compounding do the heavy lifting.